Welcome to the Game Plan Podcast, the show that helps you grow wealth, create passive income, and achieve your financial goals faster. I'm Damodar Mata, author, blogger, and financial advisor in Dubai. This is weekly market update as on 14th November 2021. The title of today's episode is The Double Whammy. The US markets reversed some of its growth from the previous week as investors digested the data showing highest inflation in 3 decades. The Consumer Price Index (CPI) reading came in at 6.2%, the highest level since 1990. While the Producer Price Index, also known as the Wholesale Index, was at 8.6%, the highest since 2010. While some factors driving the inflation appear transitionary, a few persistent factors like rent and wages remain. Given that the inflation is continuing longer than expected, investors and policymakers are facing a double whammy of stagflation and high market valuation. What is stagflation? Stagflation, in simple words, is high inflation combined with a stagnant economy and rising unemployment. Road to potential stagflation. After a stellar recovery from the pandemic lows, the US economic growth was a mere 2% in Q3 2021. Well below market expectations of 2.7% and falling sharply from 6.7% in Q2. Please see the chart on my blog Financial Planning in Dubai showing the US economic growth since January 2019. The Federal Reserve is now in a fix trying to contain inflation, which it was trying to bring up for so many years. With the bond purchase tapering already on, rising interest rates is another tool the Fed can use to contain the raging inflation. While the Fed has indicated one rate hike in 2022, the market is pricing 2 hikes and some experts are even predicting 3 based on this week's inflation readings. High market valuations. It is no secret that the market valuations are stretched and probably at a tipping point. Unless the following factors improve quickly and support high valuations, a correction is not unlikely. 1. Supply chain bottlenecks. 2. Energy prices. 3. Economic growth. 4. Decrease in unemployment. 5. Earnings growth exceeding market expectations. European equities continued to rise marginally last week. The Eurostoxx index gained 0.6% and the individual country indices also rose marginally, except Italy, which was down by 0.23%. A strong wave of coronavirus infection is forcing European nations to consider introducing restrictions and lockdowns. China. Chinese stocks advanced last week on speculation that the government may step in to support the ailing real estate companies on the brink of default. The large cap CSI 300 index rose by 0.95% and the Shanghai Composite Index added 1.4%. Inflation is also on rise in China. The Producer Price Index PPI increased to 13.5% in October, the highest in last 26 years. Indian equities fared well last week with the Nifty closing above 18,000 and the Sensex closing above the 60,000 mark. Outlook. Despite the double whammy of potential stagflation and stretched valuations, the outlook for the year is still positive. However, the need for prudent portfolio diversification is more pronounced than before. Value investing in sectors like financials, energy, industrials tend to perform better amid rising interest rates. At the same time, industries like healthcare, consumer staples, utilities also tend to fare better when the inflation is high. Including the above sectors can provide your portfolio a better balance and a cushion to ride the volatility. Holding 15 to 20% cash in your portfolio to take advantage of a potential market correction is also a good idea. This was weekly market update as on 14th November 2021. Hope you found it useful and engaging. Tune in next week for news, views and market moves. Subscribe on YouTube, Apple or Google Podcasts or on your favorite podcast app. You are listening to the Game Plan Podcast, the show that helps you grow wealth, create passive income and achieve your goals faster. I'm your host Damodar Mata. Until next week, stay safe, stay invested.